Developing your own trading strategy. Welcome to Lesson 14. Now that you've learned about different trading styles, indicators, and risk management, it's time to develop your own trading strategy. A well-defined strategy helps you stay disciplined, make informed decisions, and manage risks effectively. Let's get started. Why a trading strategy matters. Without a trading strategy, you're trading blindly. A structured plan provides a roadmap for making better trading decisions and avoids emotional, impulsive actions. Here's what a good trading strategy does. Defines clear goals, outlines entry and exit criteria, implements risk management techniques, helps you track performance and refine your approach. Now let's break down the key components of a winning trading strategy. Key components of a trading strategy. To build an effective trading strategy, you need to define these key components. 1. Define your goals. Are you looking for quick profits or long-term gains? Be specific about your trading objectives. 2. Choose your trading style. Will you be a day trader, swing trader, or hodler? Choose a style that fits your lifestyle and risk tolerance. 3. Select your markets. Will you focus on major coins like Bitcoin and Ethereum, or altcoins with high volatility? Research the assets you want to trade. 4. Develop entry and exit criteria. Use technical indicators, chart patterns, or fundamental analysis to determine when to enter and exit trades. Example: buy when RSI is below 30, oversold; sell when RSI is above 70, overbought. Use moving average crossovers or MACD signals to confirm trends. 5. Set risk management rules. Risk management protects your capital. Never risk more than 2% of your capital per trade. Use stop-loss orders to limit potential losses. 6. Create a written trading plan. Document everything. Your plan will keep you accountable and focused. A well-defined strategy eliminates guesswork and builds consistency. Testing and refining your strategy. Before using real money, you must test your strategy. Here's how. 1. Backtesting. Apply your strategy to historical data to see how it would have performed in the past. 2. Demo trading. Use a demo account to practice without risk. Track results and look for patterns of success and failure. 3. Refinement. Adjust your entry, exit rules, risk management, and market selection based on backtesting results. A strong strategy is tested, refined, and improved before going live. Action plan for the week. Here's your weekly action plan to build your own trading strategy. Set clear goals. Define your trading objectives and desired outcomes. Choose your trading style: day trading, swing trading, or hodling. Pick the one that suits you. Research markets. Identify which cryptocurrencies you'll focus on. Develop entry and exit rules. Choose technical indicators and signals for trade execution. Implement risk management. Define stop-loss levels and position sizing. Write your trading plan. Document your full strategy as a guide. Test and refine. Backtest your plan and demo trade before risking real money. A disciplined, structured approach leads to consistent success. Conclusion. Developing your own trading strategy is a crucial step toward becoming a successful trader. With clear goals, entry and exit rules, and risk management, you can trade with confidence and consistency. What's your trading style? Let us know in the comments. Like, subscribe, and turn on notifications for more expert crypto insights. See you in the next lesson.